University of San Francisco School of Management. My name is Susan Evans. I'm the Associate Director of Alumni and External Relations. Our downtown USF campus offers graduate degrees in MBA, data analytics, information systems, financial analysis, nonprofit management, organizational development, and public administration. Basically anything you're looking for in a graduate degree we have to offer. We have a few people here from the admissions department. Please raise your hands if you're in admissions. Please reach out to these people later if you have any questions about any of our graduate degrees. Tonight we bring together our awesome USF School of Management alumni, students, and external business community for a unique learning experience on angel investment funding. We're going to learn about the major risks and consequences of angel investing. But how cool would it be to put on your resume or LinkedIn profile, I'm an angel investor? If we don't scare you away first with Vijay's talk, you too can learn the possibility of how to become an angel investor this evening. I'm honored to introduce to you Professor Vijay Mehrotra, who teaches at USF's MBA department. Prior to becoming a USF professor, Dr. Vijay Mehrotra was a successful entrepreneur and startup executive in, you guessed it, the Silicon Valley. These days, in addition to his teaching and research, he also wears a lot of other hats. Vijay is an angel investor, analytics consultant, husband, father. He's a Burning Man camp leader, and a Giants fan. Vijay holds a Ph.D. in management science and engineering from a little school called Stanford, and a BA in mathematics and English from St. Olaf College. Vijay also holds very few grudges. Without further ado, Professor Vijay.
I came to talk to Susan a couple of months ago, and while we were talking, she says, what do you think about doing something with our alumni and with our business community? And I said, great. I do this public storytelling performance stuff. I could tell you a story about Burning Man or about the first time I went to jail or anything like that. She says, no, that's not going to appeal to our audience. What else? And ultimately, we came down on the subject of angel investing. So I'm really excited to get a chance to talk to you guys about that. In order to tell you about becoming an angel investor, it should, hi Opinder, I should probably start by talking about, before I was an accidental angel investor, I was an accidental entrepreneur. I had a plan for what I was going to do with my life from a very young age. And the plan was simple. I was going to go get a PhD and then go to work in the business world and make enough money to buy a house in San Francisco and then retire to become a professor. And if you look at the trajectory of what I've done, in some sense, that's exactly what I've done over the last 20-something years, but it didn't exactly work out as planned. I hadn't planned to be an entrepreneur. I didn't grow up in an entrepreneurial space. I didn't grow up in a time that was so rich in entrepreneurship as being in the culture and in the water of kind of how we live and work here. I thought I was going to go work for somebody like IBM or somebody like Hewlett-Packard and raise enough money. And unfortunately, the first job that I had out of graduate school was just so terribly miserable that I had to revise my entire plan. I was working at a small analytics consulting company, and all I did during those 16 miserable months was write code to prepare data for other people to write code to analyze, to feed to our clients. And so I bring that up to say that I don't think I would have become an entrepreneur had I not been so unhappy. And we'll talk in a minute about characteristics that I look for in entrepreneurs, but unhappiness is one of them. Our story is interesting insofar as these are my two business partners, and our first client was Intuit. And the project that we started with Intuit was how do we analyze the traffic from calls into your customer service call center to understand why customers are calling so that you can eliminate those problems. The project was codenamed If the Phone Doesn't Ring, It's Me, which is the title of a Jimmy Buffett song. And we were so successful in that project, we saved them about $2.2 million over the first 2 years, and that funded a lot of additional consulting and helped us grow our business. We were all very clear that none of us wanted to hire a bunch of people to do sales and marketing for us. We didn't want to raise money to grow out an organization, but we wanted to grow our business. And so one of the areas that we got into was something that we called venture consulting, in which we did work for pre-IPO companies in exchange for equity at reduced rates. And this story has a happy ending. Two of the companies that we did venture consulting with were both, in a period of a few months, acquired by public companies. And they had, prior to that, acquired our practices that were deeply aligned to them so that there'd be no conflict of interest or confusion for their acquirers. And so the consequence of all of that, with a happy ending, is I got to retire to life as a college professor, as a Giants fan, as a father, and as a professional storyteller, a public storyteller. That was all wonderful, but angel investing, that was still not on my radar. Every one of my confessions has an image that goes with it. I'd like to give you a moment of silence to just take a good look at this guy. I first kind of bumped into angel investing when I was visiting a friend in Minneapolis, and he said, "Hey, here's a surprise for you. Our friend John is coming over to visit tonight." Now, John lives in San Francisco. He just happened to be in Minneapolis calling on a customer called Digital River, which was a large kind of software transaction processing warehouse. And John came stumbling through the door at 9:30. And he looked at me and he said, "Dude, do you want to invest in my startup company?" And that got me immediately to my first rule about what kind of angel investments to get involved with. My first confession is, invest in entrepreneurs who are sufficiently obsessed with their business success. Notice that I didn't say obsessed with their valuation of their company, not obsessed with their fancy office or their title or their big shot customer names, but obsessed with the success of their business. Because if you're not, it's just too hard. The hours are long, rejection is really consistent, failure is a really consistent part. There's a famous saying by Eisenhower that planning is priceless, but plans are worthless. Now, I did say this once to my students, and there was one student who raised their hand and said, "Who's Eisenhower?" But I think that the important piece of that is that's something you hear from military folks in a slightly different way, which is no battle plans survive first contact with the enemy. That the situation that you get into is going to cause you to have to change. And if you're not sufficiently obsessed, if you're not aware and work excited about being aware of all the different people that are pursuing things that might be relevant to your venture or to who the big players are or to what the technology platforms are that you need to be compatible with in order to get the customers that you imagine getting. If you're not sufficiently obsessed with your business, you're in trouble. So, rule number one. My second rule is kind of illustrated by this cartoon, and as the father of an 11-year-old daughter, this seems a lot like the school carnival that we have in about 10 days, where there are certain events that are just parent-focused. But the key point of this picture is, look at the people that aren't buying, the forlorn kids in the foreground, and look at the people that are buying. My second rule is, invest in people, invest in companies who have a very strong idea of who their customers are and why they do and don't spend money. And my poster child for this company is an investment that I made earlier, actually late last year, in a company called Type A Machines. Type A Machines is a 3D printer company. There are a lot of 3D printer companies out there, but Type A Machines is very, very clear on what they're investing in and who their customers are. Their customers are people doing anywhere from 1 to 999 units of something that can be 3D printed within a particular size and within a particular size box. And their cost advantage to that customer, the value and the cost of 3D printing with Type A machines versus doing the best alternative out there, which is injection molding, is radical and clear. And the fact that they were able to articulate this story to me in terms that I could understand, A, and B, that I was able to very quickly verify through some of my former students that, in fact, they did have this advantage financially and operationally and in terms of reliability so that they could make this particular customer space go. Extremely valuable to me. So I promise not to sell any of these companies too hard, but Type A Machines is definitely one to be aware of. It's definitely a company that knows who its customers are, knows who it's going after. So Rorschach test for everybody here. What do you see on the screen? Sumo wrestler. What else? Somebody about to get squashed. Good. Leverage, right. So my rule number 3 for you is invest in companies that have some kind of unfair advantage. And my poster child for that is a company I invested in about 6 years ago called Resonate Networks. Has anybody heard of Resonate Networks? Pinder, you've heard of Resonate Networks? Well, this will be great. We'll talk afterwards. Resonate Networks, it's not surprising you haven't heard from them. They're a DC-based company whose primary customer base, whose target customer base starting out was political advocacy organizations. And they had started in the business of political advocacy themselves. They've developed a platform to help their customers identify people that are likely to support their causes. And the way that they do this is by every 6 months or so doing an offline survey of a few thousand people, and then with the permission of those people, watching where those people go online. And so they get information that's unique and out of context. And having a unique advantage, having an unfair advantage, definitely attractive to me as an angel investor. And sometimes that advantage isn't quite as obvious as the sumo wrestler. It's their vision and their ability to see what's there because they're deep and knowledgeable. This really connects with knowing your customer and knowing and seeing the opportunity that you have and having an unfair advantage. Now, the punchline with Resonate Networks is the unfair advantage they have, and this is a politically incorrect thing to say, is that their early investors were people that were buying their services, politicians on both sides of the aisle. And investing in these guys, the unfair advantage they had is they had a market with whom they had relationships, the ability to sell into government organizations, to have all of that structure approved, and customers who wanted what they had because they had no other way to reach their customers, to reach their audience outside of obvious, expensive, blunt force approaches. So Resonate had an unfair advantage in that it had a pipeline to customers that enabled us to build out our products with far less funding than we'd have to do if we were designing from scratch. Couple of notes on that. Number one, the question that the other side of this question, the other side of the know your customer question is this market so small that you have no opportunity to grow the business? And that particular piece of the puzzle is a hard one to get to the bottom of if you don't know something about that domain. And for me, yeah, George.
Hey, Vijay, great to be here. Quick question on unfair advantage. Is that like all 5 of the forces and Porter's 5 forces thing where, it's your advantage in one of the various spaces or anything? Or
No, from my perspective, when I talk about an unfair advantage, it's something that they can very quickly get to and exploit in order to get market and customer traction. Beyond that, to our earlier comments around evolution and not knowing what's out there, being sufficiently obsessed, we know there's going to be adaptation. Is there an unfair advantage that they can get to get traction, to get told in a reasonably sized market from which they can advance? I've never taken a strategy class, so I have seen Porter's 5 forces model, but I'm not somebody that goes to that instinctively. I go to Jim Shaw, and then he gives me the Porter version of it. For those that know Jim. So My fourth rule is basically, if all there is for me, the size of angel investor that I am, all there is for me is the opportunity to write a check and hope, I'm not going to be all that enthusiastic. I'm looking, is there something else that I can bring to the business? Is there something else that they can bring to me? And my poster child for this is a company called Grand Junction Software. The CEO of Grand Junction is a gentleman named Rob Howard, who's been in the local delivery and local delivery technology markets for a long time. I met Rob on an airplane in 2003, and he's been coming to give guest lectures to my MBA students every year, every other year. And after the lecture that he gives, he and I spent a couple hours together with me just asking him questions, him answering questions about his business. It's been really valuable to both of us. It's been really valuable to my students. And part of what I got out of that experience over 10 years' time was the chance to understand how he thinks and how he invests. The other part that I got is a valuable asset that informs what I do in the classroom. And so there's huge value to me separate and apart from writing a check. There's huge value to Rob in having me on his team simply because he's used to using me as a sounding board. He's comfortable sharing information with me and getting a perspective from me that he's not defensive about at all.
How do you do that? As a board member or as an advisor?
No, as an informal advisor, sometimes as a formal advisor. But more than anything, it's a personal relationship. And I should put in a plug for our downtown center here. I appreciate those of you that are coming here for the first time. Hopefully it was convenient for you to get here. But since we've been in this building, since my office has been in this building, it's been wonderful to have access to folks and to be able to get to them with a short walk rather than a schlep from our campus and a search for parking. So is there something else in it for me that's valuable to my students, that's valuable to me personally? Is there something else in it for the company besides me writing a check? Because there are a lot of places they can go for a check. There's nothing unique about me as an angel investor with deep pockets, because I'm not an angel investor with deep pockets. Is there something else that I can bring to it? Is there something else that they can bring to me? So what do you see there? The trust fall, right. So that's exactly right. And one of my rules, my last rule that I'm going to share with you guys is invest in people who you trust deeply and who share your values and are bought into it. You're bought into what they're doing, not just because it's financially exciting to you, but because you believe that if they're successful, the world will be a better place. My poster child for this is a company called Clearly Next. Clearly Next is founded by a gentleman named Elliot Brown, who I've known for a long time. And Elliot, for a long time, ran a not-for-profit helping low-income people enter the professional workforce. And what he discovered over time was that not only was this something that he knew how to do successfully, but this idea of entering the workforce wasn't enough to create sustained success. That it wasn't enough to enter the workforce as a low-income person or disadvantaged person, but you had to have hope. And you had to have a sense of self-efficacy and the ability to develop your dreams and then to go after them. And so Clearly Next has taken those ideas and developed a systematic program. I call it Jenny Craig meets What Color is Your Parachute? Think about that for just a second. If Elliot is successful, if Clearly Next is successful, I'm extremely excited because they've done something good for the world. I know there are going to be twists and turns in the road, but Elliot is somebody that I trust, whose values I understand pretty deeply. My joke about investing in Elliot is I used to give money to his nonprofit without equity. It was really easy to write him a check. So a summary of my confessions is really the following. Is the entrepreneur sufficiently obsessed? Are they going to do the work that's needed? Are they motivated? Are they hungry? And do they have the bandwidth? And do they have the expertise? Are they sufficiently obsessed? Does the company have some exceptional knowledge about their customers and who their buyers are? And I know that that one's a tough one for all of us to get our heads around insofar as disruptive technologies, new entrants, maybe aren't that specialized. New technologies sometimes haven't got a home that's so clearly defined that the customer that they'd be going after isn't necessarily obvious to them. And that's true, and we've seen a lot of successful companies like that that didn't have this sorted out up front. But that's not a risk that I can bear as an angel investor. And so I've got to be really clear around what kind of early stage venture, and it's got to have a faster path to the market. It's got to have a faster path to customers who aren't just interested in it and curious about it, but that are willing to pay. And number 3, do they have some kind of unfair advantage? Do they have some kind of knowledge, some kind of assets that are going to enable them to compete quickly and to succeed quickly at some level so that they can fund beyond that? If not, I'm vulnerable to a whole lot of dilution and a whole lot of downside if they haven't got some kind of unfair advantage. For me personally, given the scale and the size of investments I'm doing, there's got to be something in it more than just writing a check to the investor. There's got to be some kind of value that they can create for me and that I can create for them as a result of our relationship. Yeah, go ahead.
I was going to say, this summary sounds like it's all qualitative rather than quantitative.
Yes. It's very uncomfortable for me as somebody who's got a PhD in a quantitative field. All of this is qualitative. That's actually, you're about 30 seconds early with your comment. The next slide is going to address that. So thank you. Hold that thought. I'm going to take your question in just a second. And then finally, do I trust, in a deep level, do I trust the key players? Do I trust their values? Do I know who they are as people? Do I know why they're doing what they're doing? Well, this is exactly the punchline, right? Is that all of these things that I've talked about are qualitative. All of them are things that in the end depend on judgment. And famous quote about judgment from Will Rogers is that good judgment comes from experience, and a lot of that experience comes from bad judgment. And so I was going to close by telling you guys a little story. And I call it a story from the School of Hard Knocks. And can we leave this up? I was looking to see if we had a video mute. Take a minute, everybody take a minute, and grab a piece of paper. If you haven't got one, get the person next to you, a piece of scrap paper. I want you guys to write down 3, 4 bullets, 2, 3 sentences, however you want to do it, what you think success is and what you think success looks like. We're trying to invest successfully. We're trying to invest in people that are going to be successful. But let's just take a quick second to be clear and as explicit as you can about what you think success is. So when I was 17 years old, the first week that I went off to college, I met 2 people that for a long, long time after that really defined to me what success looked like. Steve was a year ahead of me. He was the older brother of some friends of mine, and he was a big man on campus. Tall, good-looking dude, blonde hair, hot girlfriend, pre-law, cross-country team, A student, running around, going to France to study abroad, doing stuff. And he'd look at me and say, "Hi, Vijay," and he was the image of success. And I was just thrilled that he talked to me. I was just thrilled that he acknowledged and knew who I was. That was enough for me to bask in that glow a little bit. The other guy was a classmate of mine named Mark, and although we were roughly the same age, he was already much more of a grown-up than I was. He was reading the Wall Street Journal on the library steps, and hustling off to class, and joining the student senate, getting elected to the student senate, getting in with student leaders, having coffee with professors. He was a genuine grown-up with a clear sense of where he was going and what he was doing. He was launching for a career in finance, and he was motivated and organized around doing that every day. And Mark and I had a couple classes together freshman year. We got to be friends. And when we were seniors, we eventually moved into a house together. By this time, Steve had graduated and gone off to law school, and I would lose firsthand touch with him for several years. But I would hear reports from him about how successful he was doing. First going to law school, passing the bar exam, starting a legal practice, hanging his own shingle, growing his business. Married his hot, redheaded girlfriend, 3 beautiful kids, vacations in the south of France, Ironman triathlons. Perfect. Success. Mark went off to work for a big bank in Chicago, was building his career, making a bunch of money, marrying his high school girlfriend, buying a big house in Lincoln Park, and staying in touch. He's somebody that I called to provide support for me when I was struggling my way through graduate school. He was somebody who came out here with another friend and rallied me when I was ready to quit. I depended on his support for a long, long time. And when it came time to start the business, going back to the beginning of our talk, he was somebody whose advice and counsel I sought out. How many people have friends like that? Feel like you know them pretty well. You feel like, in terms of the categories, some of the things we were talking about, these are people that you trust, whose values you understand. When it was time for me to get married, Mark was the best man at my wedding, and he asked what we wanted to do for a bachelor party. Pause for a minute, let that sink in your imagination. I said a ski trip would be safe, steady, and while we were out skiing in Colorado, at the very top of the mountain, we ran into Steve, our lawyer friend from college. And I'll remember that moment for as long as I live, because I thought of these guys who'd always been my picture of what success is, at the very top of the mountain, at the pinnacle that day. About a year later, I flew back to Minnesota to attend a wedding. And at that wedding, a woman sought me out and said, I understand that you were good friends with Steve. And I said, yes, I was. How's he doing? Expecting to hear great stories about his progress. She says, you haven't read the papers here in Minnesota, have you? Steve had been, because he'd been running his own legal practice, Steve had been cashing checks from settlements that were intended for his customers and putting them in his own pocket. He'd been using those checks to fund the lifestyle, the house, the private schools, the vacations in the south of France. And he had swindled about 70 different clients for about $800,000, most of them old or disabled in some way. And he was now in prison. And I don't know if you've ever had that experience, but I know a lot of angel investors have had, to find themselves shocked at what they'd invested in. In my case, I was shocked at what I had imagined this person's values were, what I imagined that their life was, and find that I was wrong on both counts. And I didn't figure I'd ever know the truth of the matter. Meanwhile, Mark, who'd been the best man at my wedding, who'd been the voice on the other end of the telephone every couple of weeks for 20 plus years, started to get more distant. He was running around, at this point he was running a hedge fund and also doing private equity deals, a couple of which I'd been involved with. I'd been an investor in his hedge fund as well. And harder to get hold of, not responsive, not clear in his communications, kind of a unexpected drifting away of a very good friend. Eventually, he let me buy into the idea that it was just a matter of marital problems that he was having. It's August of 2010, I received a call from another roommate from college telling me that Mark was in some pretty serious trouble, that it was going to be in the next day's news, that all of his assets had been frozen, that he'd been embezzling from his hedge fund, that $29 million had gone missing. $200,000 of mine had disappeared on paper. And I was stunned and shocked. I did the only rational thing that I could think of doing, which was get in the car and go to Burning Man. And when I came back, I got more of the news. It turned out another guy from my wedding party was the primary witness for the government against Mark, because Peter, in addition to losing all the money in the hedge fund, he'd also taken out two fake $2 million lines of credit in a bank that he was the chairman of, that he'd put in a private equity group together to buy. And one of them was in the name of one of my other best friends. And at that point, I didn't know what to do, but I realized that I knew somebody else that had gone through something like this. And I looked up Steve. It turned out that while he was in prison, he had started working with a U.S. attorney that had prosecuted him and put him away to develop educational programs for business students, for alumni groups, for law students. So I called Steve, and he provided a tremendous amount of support for me during that process, as well as for Mark in going through the process of coming to terms with the mistakes that you'd made and the lapses in judgment and the legal process. And I made a decision to look at the whole of the story and not just the back end of it, and to maintain my relationship with Mark, which I've maintained through his prison sentence. He's going to get out of prison in September of this year. There are a lot of reasons as to why, but I bring up this story in response to you folks that have said, hey, how do you do these things? How do you know whether you have deep trust in the people that you're investing with? The answer is that you don't. Angel investing is an inherently risky business. And I've talked about it as if I'm a professional, but I'll be the first person to tell you that I'm an absolute amateur. 8 or 9 years into this, 10 or 12 deals into this, I am still learning. I am still trying to figure out what I'm doing. On the plus side, I've got an actual professional full-time angel investor here with us tonight, and I'm thrilled at the chance to introduce him to you, to ask him some questions, and then to open up our discussion to questions for both of us. Shawn Merani is a partner in a company called, I want to say Rocket.vc, Flight.vc. And Shawn's, as I've gotten to know Shawn, it's very interesting. His career has really shown the different things he's been involved with have reflected both the entrepreneurial culture that we live in and the different types of digitally enabled technologies and disruptions that are going on out there. He was a business development person at a company called Reach Local that was working with companies to help them figure out how do they use digital technologies to effectively reach their audiences, a job that didn't exist 20 years ago. He was also an investment banker in a previous life looking at technology ventures. And then he was a founder of a company called Liquid Private Shares that was involved with, as companies like Facebook and grew larger, before they were ready for public markets, there was still a market for their stock, and Liquid Private Shares was involved in making some of those markets and enabling some of those transactions. So Shawn's somebody that's been on the operational and business development side and the financial side of technology firms at a lot of different levels and a lot of different stages. And he's going to talk a little bit tonight about Flight.vc, but we're very lucky to have somebody who's been living with this stuff, not like me who's been dabbling in this stuff, to join us to help give us a perspective on angel investing and on early stage ventures. So please join me in giving a big hand and a USF welcome to Shawn Merani from Flight.vc. So Shawn, you want to dive in and maybe just, and I feel particularly bad because I got the name wrong the first time, maybe just give us some background on what Flight.vc is. Maybe that is a good place for us to start.
Yeah, so me and my partner, Gil Pencino, we came together last year to figure out how to, I guess I'll give you a little more background. So Gil, he's been around the Valley for quite a number of years. He started angel investing in the late 90s, much like Vijay, kind of as a hobby while he was an entrepreneur. And he found some success. He seeded a couple notable companies, one being LinkedIn, the other being PayPal. So he's over time he's created quite a track record, and he's an investor in another company that started leveraging the crowd to make larger sized, I guess, angel investments, and the company's Angel List. And so he was one of the when they created a new product called Syndicates last year. Or I guess the end of 2013, the CEO reached out to a bunch of the angel investors and said, there are people on our platform that want to invest in your deals with you. So if you can get a greater share allocation in these companies, you can leverage the crowd and make bigger investments. And so that's kind of at a point in time where he was able to shift his model from being a direct angel investor and writing smaller checks to writing bigger checks that look like other early stage VCs, to writing $200,000 plus checks. And taking advantage of the crowd. And so that was the genesis of what we were calling Flight.vc. So we recently named it, but what we were doing is providing avenues that people can invest in, deals that they otherwise wouldn't be able to access, deals that we have direct relationships with the entrepreneurs, and that we help actively, and we're providing access to the masses, to the crowd. And so it's a leveraged model, just like venture capital, where we're putting in a little bit of money and the rest comes from other people's money. But for what we're doing, it's coming from individual accredited investors as opposed to like pension funds, family offices, or traditional VCs raise their money.
Shawn, can you give us an overview of kind of the criteria that you look at and what kind of rules you guys follow just in assessing early stage investments?
Yeah, so I mean, much to your point, there's still a ton of risk associated with what we do, and a lot of the things align very well with what you had up there. But the first and foremost, it's the people that we're investing in the team. It's the most important thing. How they're approaching whatever problem that they're trying to solve. They've done it before, or if they have like special expertise, as you were, passion or foothold into what they're building. So that's one thing. Going after big markets or markets that they see are going to evolve over time. That's another big thing. And then the other is just general product development. What have they built to date? Nowadays you can build a lot with nothing, and so seeing kind of what a person can do with those circumstances and with those tools in front of them is also a definite proof point. And then just general, we like to see traction, see how they've been executing in the marketplace. What if it's a SaaS business, what's their pipeline? What are some companies that they're working with? If it's a consumer business, you can really get off to the races and see customers using your product, your app, or whatever in pretty short order. So we look at those kind of things.
Great. We always talk about our successes, and one of the questions that came in from an audience member was, can you talk about some of the mistakes that you've made, or that Gil's made, or that Flight.vc has made, and what you learned from them?
Yeah, I mean, I think as a whole, we're too new to say that we've made a bunch of mistakes. But just looking at the numbers, you're not supposed to succeed in the vast majority of these deals. So it's going to be an interesting point in time, especially because we're leveraging the crowd to see what the reaction is to that. But that's why you're going after it. That's why accredited investors are putting a portion of their earnings to it, and they're sophisticated people. But I mean, Gil, he always says, he wouldn't really be anything without those big winners, without the LinkedIn. And for LinkedIn, it was a guy, Reid Hoffman, who has a background in politics and was working and building like a networking social app. He said, if I had to pick one aside from his raw intelligence, I would have thought that would have been a definite loser, and it was the biggest winner in his portfolio. And there were a variety of other companies he thought would be sure things and went to zero the fastest. So there are a lot of other factors that we can't really factor in, macro factors that happen and just destroy a business. And so I don't think we really think about those, and we just try to that's why we focus on the people in the market, and hopefully they, we're not micromanaging them, and so there's a lot of trust that goes into this to execute on vision.
Great. Another audience question that came in was, how important is it for a company that you guys will invest in to have a CTO or to have a tech lead?
I mean, it's important that they have a full team. Usually, if it's a sole founder and if they can't code, you ask questions, why they can't do it, why weren't they able to recruit. I think it's on an isolated basis, but usually if they have a good answer and why there's a reason, we can overcome that. If they're a serial entrepreneur and they kind of sketched out, and that they have a deep Rolodex of people that are technical that want to work with them, maybe they don't need that CTO. So I wouldn't say there's a yes or no answer to that. But yeah, we usually like to see a full team in place and it being engineering heavy is kind of goes without saying right now.
So any other red flags that you see in companies that you guys look at? Things that cause you to turn and run, not walk?
Yeah, I mean, I think that they just don't know how to answer tough questions about their business easily. So, if it's a consumer company, like, how are you acquiring customers? And if I get a blank stare, I'm like, okay, why have I thought about your business more than you have, And so, I see a lot of companies and a lot of pitches, and so I think just understanding your metrics and why you're going to be successful, why you're going to hit your next milestones, I think those things go without saying. If you don't answer those with confidence or understand kind of underlying factors behind them, it's kind of a red flag.
I'm going to ask one more, Shawn, and then we'll turn it over to the audience for direct questions. And that's, if you got it started when you talked about Flight.vc, can you say a little bit more around strengths and weaknesses and differences between traditional VCs and angel syndicates?
Yeah, I think what we're doing is kind of evolving. It's new, and so it's different. I think the traditional VCs, right? When they write a check, they just go to a bank account, and the money comes out. We have to go raise it on a platform, but we have that mass aggregate. So I think from a timing perspective, it's a little different. But for all intents and purposes, I mean, people want to work with us. They want to work with the value that we're bringing. We feel like there's a huge differentiation that VCs don't provide, as we have across all of our syndicates, 2,500 people that have been very successful, especially majority of them in technology, and we're enabling them to help their companies. So we think, yeah, the crowd brings money, enables us to write these big checks, but they also have very valuable networks, and we're in a land of network effects, and so we are trying to bring that to bear. And that's, VCs, it's something that they also have trouble. They have, long lists. So we are VCs, so not they, us, but we have long lists of advisors, but, it takes work, it takes cognitive load to go reach out to those advisors, and there's also a short amount of time that you can do that, and we kind of are trying to enable that in mass with technology, with AngelList, and so we think that's a huge differentiation and that no one has out there.
So last word before we turn it loose to the audience is, if you had one or two piece of advice to people that were thinking about weighing in and becoming angels, what would it be?
I think, I think AngelList is a great place to start, to put small amounts of money and try to see if you actually know what you're doing. Like we don't, in some of the deals, this cohort in this time that we're investing in, you could be bad investors, right? So we don't even have the data for that. We think we're going to be good, but I think AngelList allows you to kind of see if you can make these, if you can make a decision, do you want to even see the deals that we're doing and join our syndicate, and then also make your own professional decision, and if you want to invest in our deals. And so that gives you two interesting decision points. And so invest in a basket of companies and see if you're good. And then as you are if you have more money or are more successful, you can always go be creative and go direct to these companies, or even contact them through these platforms and say, I want to write a bigger check. And they usually, if you want to write a bigger check, they want to talk to you, want to get to know you, and want to see how you can be helpful. So there are these platforms not only allow you to make these decisions in a short period of time, but also enables you to engage with these entrepreneurs rather than going to an event or trying to through LinkedIn. Like if you want to put the money to work, they want to talk to you. And so that's the interesting thing, that these transparency and the connection that these platforms are providing.
Great. Well, first off, please join me in giving a hand to Shawn. We're just going to open it up to anyone and everyone for questions, and I was told before the presentation to make sure that we remember the people sitting on the far side of the room have paid just as much as the people sitting on this side of the room. So we will keep our eyes open across the board. Questions from anyone? Yeah. Mackenzie.
Thanks for coming and speaking with us. I guess Vijay asked a question earlier about, for all of us, to define our definition of success. I'm curious, has your definition of success changed as you've proven yourself successful? What was it 10 years ago?
Putting me on the spot. Success. Yeah, I mean, I just like to do, back then I guess it was similar. When you come out of school, you want to have like a cool job and buy a cool car maybe, and now I just want to work on cool things and work with smart people. It's really shifted from that. It used to always be about the job, about the path, about the function, and now it's just working with good people. And so, me and my partner started working together. We'd known each other socially for years, but we never worked together. And so we kind of had a short period of time where we were just feeling each other out, and it worked really well. And I enjoy working in high-powered an area that I can have a lot of flexibility, with a partner that where we trust each other, and so those are things that really motivated me. And so I think regardless of how we do as a business, I think that's success in itself, right? And so I guess, I hope that answers your question. But, yeah.
Okay. Malvika, I'm going to pass the mic back to you. George should have sent it back, row by row.
Okay, hi, I'm Malvika, and my question is, what are the areas in which you do end up taking a lot of risk while investing?
In like sectors or?
No, like if a team comes to you with a pitch, then what are the areas where you can take a risk or it is a little negotiable?
It's always, I think, a trade-off. It really, I think all those factors that we were talking about between the team, the sector,
the price of the deal, the traction. I think we try to feel it out and value all of the. I wouldn't say that we put it in a spreadsheet and kind of come up with a decision. And that's why we kind of have a team and other experts that we talk to help. Really, if we're on the fence, and if we're on the fence, usually we're more or less likely to do the deal. Usually, it's something that we really get it. We're really into it. We love the space. We love the entrepreneur. We love their passion. It's kind of a no-brainer. And then we have to go and try to fight for our allocation because everyone thinks the same thing. So, it really depends on so many factors.
Hey, how's it going? I noticed one of the companies you invested in was Xerx, and I'm sort of interested why you chose Xerx over Lux, because their business models are so similar. If you can offer any insight on it.
I've been an advisor to Xerx. I know the CEO really
Well, Shawn's a good friend of mine, and I'd say it's too early to tell or why one's better than the other. They're a little different in both team and kind of the way they're executing, but I would say it's too early. I'd say arguably the valuation is bigger than the companies are, but I like the way that Xerx executed. That team is very operationally sound, and they've always believed in the data. So if you guys don't know, it's a valet parking app that you can call with your phone. So I work down in the Soma. I can call a valet to pick up my car, and then I can come here for this talk. And then when I'm ready for my car, I hit the button and they'll drop it off. So it's $15 a day, so that's way cheaper than anything usually you can get in the city. And so they're super data driven. They worry about how many valets are on the street. They understand that if you have a bad user experience, you probably are less likely to use it. So they're really focused on the operational component. We thought that was really smart. But I think Lex is also a tremendous team. I know my buddies are investors in that company too. So who knows? I think they can both win.
Vijay was my professor, so I'm very comfortable in asking him questions that are kind of a little sharp. So you characterized the angel investor and point 2 and 3 on your slide, which is who are your customers and invest in companies with an unfair advantage, are the only market driven. The other stuff sounds like friends and family, where you get to know the person and you understand. I'm wondering, I have a question for both of you. If you could characterize the difference between friends and family investment, angel investment, and venture investment, if there are characteristics that separate them, and then what price points? In other words, how much would an entrepreneur expect from either of those groups?
So what I could say, actually, not so long ago, I reviewed a book on the topic of what do angel investors look like today. And a disproportionately large number of them were friends of friends and family. The myth and the image that we have of the angel investor being a wise, retired business person who's very hands-on, who brings network credibility and relationships and all that, the data did not bear that out. The study was funded by the Kauffman Foundation, Kansas City, that have been studying and investing in helping us understand entrepreneurship for a long time. And so I think the first comment in response to George's question is that a substantial percentage of overall angel investing is done by friends and family and friends of friends and family, extended network type stuff. One of the things that study called out as separate and fundamentally different were angel groups and angel networks. And I'm going to let Shawn talk a little bit about those. We know that those have been on the rise the last few years in the Bay Area and more generally across the country.
About the angel networks?
The angel networks.
Yeah, I mean, I see them less and less, especially as there's other resources, and there's like micro VCs, seed funds, guys like us, Angel List in general that are there at the earlier stages. So I feel like those guys have been disintermediated a little bit because there is less value and they kind of have a different way of investing. But I think, to answer your question, I think friends and family is like the first money in before, like when I was talking about what we look for, product attraction, oftentimes it's like, we need $200,000 to get started. And so, they'll get that first tranche in, but, I think people do, from what I see, and when I've done it, or when people have given me money, it's just, they don't do it to try to get a return, they do it to support you, right? And because they end up getting it on the same terms as like the next round, usually on the same note, and so really there's no financial upside for them. So I just think it's just easier money to get access to get going, usually like first-time entrepreneurs.
So where are the categories? I mean, today, friends and family, what, 10K per friend, and angels, 100, 200K, and VCs, 3 million? I mean, how does that break out?
Well, my sense is that
Your mic isn't on.
it's not.
Could you guys pass that one?
I've got it. We're back on. We're back on. I see angel deals, and I've been in angel deals that have come down under $10,000, where the individual is a $10,000 investor, the deal itself maybe $100,000 or $200,000, but it's still considered an angel round. And then I've seen other deals where the minimum per investor was $50,000, $100,000, or $250,000. And so I don't think this is an area where categories and labels are all that precise. Do you have anything to add?
I agree. I think it's just hard to bucket it. There's been a whole trying to figure out, like, is a seed round still a seed round? Is there a post-seed round? Is that before the A round? It's like these lines have become blurred that we really don't know what is what. It's kind of like where the company is, the amount that they're raising usually is kind of proportionate, but do the labels even mean anything? Unclear. Most seed people want to be the first or second money in, so in those first two tranches, and they usually have ownership requirements, and that'll dictate how much they put in and when. They take active board seats. That's pretty common amongst the micro VCs. So I think that's usually what dictates it, not timing or round size, labels.
Hey, so I've been in the internet space for a while and fortunate enough to join some pretty successful startups, and now I'm started getting into a little bit of advising and mentoring. But when I was going to these companies, I basically was looking for patterns. When I went to these companies, I really looked at sort of the space, the other players in the space. I was basically looking at it from a VC's perspective pretty early on. So when I went to them, like hotjobs.com, I knew there was only one other major player in the space, Monster. They were early on, they had the team, like everything was in my favor to go there. And they did well, they got bought by Yahoo. Then Trulia, same thing. I linked all the parallels basically and just looked at the patterns, and Trulia was pretty early on. And they grew up and they went public, and eventually they got bought by Zillow. And then went to another one called Loku. It had the team. It had also, like, second biggest in the space. It was bought by GoDaddy. So in any case, when you look at these different investments, is there some additional sort of pattern analysis that you do to look at them? And also, when you start the angel investing, now that I'm advising, I have some friends who are starting companies, not comfortable enough to invest, but when does it, how many of these usually just start with an advising role, a mentoring role, and they sort of go into, the investment stage? or how many of them of yours have sort of, they start there, you're sort of helping out a buddy, you're advising, and then it gets to that stage, because I'm on the investing piece, sort of being careful since the wife is a little more risk adverse than I am. So that was multiple questions, but the pattern piece I'm pretty interested in, and the investing.
For patterns that we look for, I mean, if you look for people that have done it before, I think a bunch of those teams, it's like they've executed before, and so you kind of know that they know how to hire teams, know how to build engineering organizations. I mean, that's team expertise and guys that have done it before. We'd love to see that. I think that coupled, I think that's the first. That's the most. If you look at all of our companies, you see that pretty consistently. We'll invest in sometimes in entrepreneurs that we've worked with or have known for a long time, and that have a pattern of success. We'll pretty much invest in whatever they want to do. One of the first investment we ever did on Angels before me and Gil came together was Alt School, and they just raised $100 million. That CEO had sold his previous company, Aardvark, to Google. Like, everyone wanted to invest in this company, and that's pretty consistent throughout the Valley. I think the other things, I think the market thing is pretty vague. But that's usually, if it's a first-time entrepreneur, you want to see what they're doing, and we want to see that it's an amazing product. I think product and then the traction thing are two things that we look for. Unless it's just the team, and the team first is usually the thing that stands out.
I think your question really was on what basis would you step in as an angel, given that you've got experience with early stage companies, you've got experience with successful outcomes, and you're looking, it sounds like, in advising roles at a bunch of early stage companies. And I think that's exactly the right place to start. I don't think that everybody's got a set of rules around patterns and repeatability and things. My thought has always been, I don't want to buy the shack on the block, or I should say, I don't want to buy the best house on a lousy block. So in addition to the team being in a good place and having some competencies that I trust, there's also this question of is the market, if they're successful in what they think they're going to do or what they hope to do, is there a market there to support big valuation? One thing that's sort of sad but true is, as an angel investor, you have two different things to worry about. The first is, who's the next money in? And are they going to be successful enough so that you've got a valuation there that reflects well on you? But then the other is, what is their ultimate play? Do they plan and hope and dream to go public, and do they have kind of a vision of a whole set of products, or are they looking to be acquired? And I think that the more companies that you see, the more you get a feeling for, hey, where, if things go well, would this lead? And because there's all these reasons you could get completely lost on how things would fail. And so I was kind of trying to wrestle with that question. If things go well, if they do as they hope to do, what's the opportunity and what does that look like? As far as managing the wife and her risk aversion, I do have a little bit of experience with that. And I think the most important piece of that is to frame it up in the context of everything else you're doing financially as a family, because the numbers by themselves are sort of, they can be scary for people if they're not presented in context. Spouses are supposed to do that. They're supposed to be your sanity check. So thanks for, actually, the questions were packed up and they were both good ones.
I shouldn't need one, but the question was, it kind of goes along with, what is the opportunity? Do you guys have a specific timeline in terms of when you expect to see that opportunity, actually happen, or when you actually feel like, this isn't actually a good investment at this point, it's time to pull the plug for me? So is there a specific timeline that you guys follow, or is it just company and investment specific?
We're early stage investors predominantly, so there's like a point in time where the company keeps raising money that we're just tapped out, so there's like a financial constraint. And then usually everyone that invested early, if there's a bad signal, and someone that's investing or they were out there in the market, there's so many other, I think, data points that you can look to that we would decide if we were in or out. If we were just, right now a lot of money is getting put to work, so what's doing well and what's doing bad, in our opinion, it's hard to distill from an outsider's point of view. So we'll make that decision, but usually at that point in time, I mean, if we wrote $1 million check in a $5 million deal, and then they're out raising at $50 million, and that $1 million with $4 or $5 million, like our fund doesn't, we can't write that check. So does that mean we don't believe in the company? No, not really, but we just can't write the check.
In some ways, your question triggers a really good response to your question, which is, if I have to worry about the time frame of the outcome, then I should be in the deal as an angel, because there's so much uncertainty in duration, never mind change in direction, that just to give a kind of a reference point, on the last day of November of 2008, I wrote 2 checks on the same day for 2 different companies. One that got out and acquired within 3 years, and one that is still private, has done 2 up rounds, 2 good venture rounds. I think that second one, and this is now, we're coming up on 6.5 years later, that's a long time to have your capital tied up. I think that second one's going to ultimately be the better deal. And if I was defining success on the time frame, obviously that wouldn't be the case. I feel pretty strongly about that, particularly because we're moving to this time where more and more people are involved in more and more early stage stuff financially. It's not a game, or it's a game that's got pretty significant consequences. And if really you need your money back in a certain time frame, you probably shouldn't be in the deal.
Hey, so my question is, I guess, more from the perspective of the entrepreneur, since obviously you both more or less have the same goal. And that is, suppose that you have the good fortune to come across an idea that you're very passionate about, and that, at least from a preliminary look, has a good market supporting it. What would you say is maybe the next big step that you'd want to, like, I guess maybe a gotcha or a stumbling block that you maybe have seen a company have to deal with, or maybe you narrowly miss, something like that?
Yeah. I'm happy to take a shot at it by predicting what I think Shawn's going to say. That is, if you find an entrepreneur who's enthusiastic, who's got an idea, he sees a market out there, the first thing I'm looking for is he able to transmit that enthusiasm and build a team? Is if he can't get complementarily skilled people, people that are equally committed, excited about his idea, how's he going to get customers? How's he going to have the passion to generate those? So that's top of my list.
I mean, I agree with you, and but I think also just when you're operating a company, and I think this is to a previous point about why I do emphasize team, is because a lot of times the best outcomes are on a business that wasn't even the initial goal of what you invested in, right? And there's the whole thing about pivot, and if you're a really resourceful founder, they'll figure out a way to find a product market fit, even if that wasn't their initial goal. So I think that resourcefulness, you hire the right people, you inspire the right people, you can make those decisions, and that's why you invest in those people, and they'll find the market. Because unless you're a board member and you're really active, and some are more active than others, you're not running the company. You're an investor. So just appreciate that piece of it.
I don't need that microphone, thank you. So as an angel investor, how involved do you want to be in the business? Can you give us an example of what that looked like or has looked like in other businesses you invested in?
Yeah, no, happy to. And to a previous questioner, I kind of look at the spectrum of stuff that I'm doing as teaching, researching, consulting, advising, and investing. And so I kind of look at those as discrete activities, and the only time that I want to be more involved than just an investor is if there's something very specific that I can add to the business.
in terms of relationships, in terms of technical counsel or guidance or expertise of some kind. Beyond that, in some ways, I don't want to be around hovering at all. I don't want to be walking around the building saying, hey, I'm an investor. You working hard? No, nobody, that's not good for anybody. So I think the answer is I want to be involved in a way that's meaningful. If there's an obvious way for me to contribute beyond just investing, and obviously anything I can do to help them succeed is in my best interest. I'm really well aligned with that.
Yeah, I think, I mean, I guess we're more institutional than a typical angel investor, so it's a little different, but I mean, we help where they want the help, and they tell us, where we don't actively take board seats. So like I said, we're not in that monthly, quarterly board call, and so whenever the entrepreneur needs us, they reach out, but try to have an active dialogue with them, and they all have different needs, and so it depends. One company, is having trouble. They've never ran a business. They've never got subsequent funding anymore. So we're helping make those introductions. That's where we can add value. We know other investors that might be helpful. Some have done it before, so they don't need our help there, but they need our help because we have a company that's a SaaS company that's selling to CIOs, and so we had a bunch of CIO contacts. So we made a bunch of intros there. So that's a different kind of help. So we try to figure it out where we can be most useful.
As angels, do you look at one or two things? One thing, if somebody's got to an incubator accelerator, does it have to be a particular type, or does it have to have a particular status, like Vijay Mehrotra seems to be the one that everyone wants to go to? And secondly, if you're putting in early seed money, are you looking at where the money came previously outside of friends and family? Is it a reputational thing? In other words, for the entrepreneur, that they get money that comes from somewhere that knows yourself?
I mean, yeah, we definitely have investors that we like to work with. We can always back channel with them and just get more data to help us make more informed decisions. So that's helpful. Then one thing you kind of mentioned was signaling, if there is an investor and if they don't invest later, I mean, there's definite signaling from that to the accelerator question. Everyone, YC Demo Day, it's a great place to go meet all your friends that invest. There's a trade-off there. I mean, they've had great outcomes. They invest in a lot of they're direct investors in a lot of great companies. There are a ton of accelerators net right now, so it's just hard to go through the weeds and go to all the demo days. And those are entrepreneurs that usually kind of need help in more ways than other, so that's just also just a direct inability to take on certain kind of risk. And so I think we appreciate that. But I wouldn't say we hold it against or for someone. Right now YC does 104 companies, so I mean that's 104 companies to go through. So it's a lot of work to do that, and so I don't think we really think about it that way. We think about them as the company, what's the space, and then YC they do a lot of curation, so they definitely command a higher price, and so we balance that with the other things. Are they going after a big enough market where we want to pay, and do they have enough traction where we want to pay up that kind of price? And so we definitely use that as a factor. So
Yeah, let's see if I'm on here. Yeah, I actually got input from a portfolio company that just said, "Hey, we just got into Y Combinator. Don't hold it against us, and don't value us any differently. Make your decision independent of that." And he just said, "Look at that." Same thing Shawn said, that there's a lot of companies and that stamp is meaningful. He said the reason that he was accepting the offer to join Y Combinator, he was a second-time entrepreneur. The reason he accepted the offer is he felt it would help him build a team faster. That was a signal to potential staff that somebody had vetted them. But for me as an investor, I didn't take it all that seriously. Lucas.
Have you guys had any big misses? Maybe deals you passed on, and why did you pass? Or I can ask.
You're asking me because Shawn already answered that question earlier.
Sorry. Vijay, specifically for you.
Okay. Well, yeah, I mean, I can tell you, and it's really in line with Shawn's last answer around, investors sitting out around, and that's, I talked about our venture consulting when I was running a consulting firm, Onward. We had two success stories, advertising.com that was bought by AOL and Blue Pumpkin Software that was bought by Witness Systems. But those were not our only venture deals. In particular, we had one that we did a bunch of work for at a very, very reduced rate that didn't get a venture round. And so the lesson to me there was just simply, not just do I think this is a good entrepreneur, but does anybody else think he's a good entrepreneur? And getting some external verification around that before we got too deep in. So that was the big miss to me was, again, getting involved in contributing resources to a company that ultimately didn't get funded. Yes. Right up here, Susan.
Can you talk a little bit about how you fight for allocation in companies? Because you could have the money, we could have the money, but it doesn't necessarily mean that the companies are going to let us invest.
I mean, you try to get and develop a relationship with the entrepreneur early enough, and hopefully he sees the value and wants to work with you. It's a two-way street, and he sees the value. It's a mutual value. Sometimes it's a hot deal and it's competitive and we get there too late, so we call our friends that are either investing in the deal or know the person well. I mean, it's a sales game. It's trying to sell why we're better or qualified or why he should work with us more than someone else. So I mean, it's different every time, but there are others. It's sales, and so it ultimately boils down to that.
Yeah, I've only kind of come across this a couple of times. Once relatively recently, and it was a sales pitch I gave us to the founder CEO. I said, number one, you know me, and you know that I'm gonna to respect you as a professional first, as opposed to being a pain in the butt investor. Secondly, the stuff that you're doing, last mile logistics and supply chain stuff, I have some intellectual capital to bring to that, and I may be able to get involved and help your tech team just as another voice, another person in the room. And I think, and that was a case where I thought I was going to get squeezed out, and he ended up growing the size of the round by about 40%, and I was able to get in. More questions? Yes. Susan, how are we on time?
Probably one more question.
Okay. Well, we 1 + 1. Because this one was already committed before we get to the last question. But everybody else has to hear you too, though.
Yeah, I can tell that. All right. I guess it seems like from everything you said that angel investing, in a way, it's really more of like something that can be sort of more fulfilling to help an entrepreneur on their way up and sort of be involved in a fun activity to sort of stimulate your mind as well as potentially make money. But I mean, do you, when you're usually investing in these, and this to you, it sounds like it's not really all about the sort of investment win as much as the sort of journey of being with that entrepreneur through, helping them succeed. Would you say that's true, or would you say you're really doing it more? It's quite risky, right? So I'm just wondering how you weigh investing in that startup versus other investments that you make.
A great question. I think I guess my strong feeling is that and this goes back to the question about timing and what kind of horizon is it. When I think about the financials of angel investing, I don't need to win today. I have a day job. I like my day job for all my students that are here. And so I'm not thinking about this in terms of this year's W-2 at all. But when I think about my long-term plan, there's a certain chunk that's allocated to angel investing, to early stage investing, and a certain goal in terms of return on that. And so I feel like I'm not answering your question because I really don't see it as an either or. For me though, that piece that I talked about quite a bit around, is there something else I'm getting out of this? Is there something else I'm giving to this? Is really important. but not if it's not going to win in the marketplace. That we reserve. The stuff that's just for fun is just for advising. Right? Go to work with a company, regardless of what might happen to them and how they might go. It's a terrific amount of fun. And frankly, I think some of my best work as an advisor is when I've told people bluntly, this is crap. This is not going to be successful. It's probably not going to get funded. And I think people thank me, 2 or 3 years later for giving that blunt feedback, because, entrepreneurs are optimists. They have to be. So last question, and since I talked a lot, the previous one, this one should be for Shawn, ideally. Felix.
Yes, so, I'm coming with Mike. Thank you. So just listening to you talk about how you vet the team, and it sounds like you put a lot of worth on their energy and ability. How long does that take sometimes? I mean, you can make a call within, maybe 30 minutes, but do you sometimes go back for a few days, try to meet them a few times here and there to make that judgment?
Yeah, we'll meet with them a few times. Sometimes there are other investors that have spent a lot more time with them that we know are investing in the round, so we'll take that into consideration. I mean, we're investing pretty early, right? We're investing in the seed round, so oftentimes when there's data, it's pretty limited. So if there's data, we like to look at it, and sometimes we'll pass if we can't get there on the team and the traction. And so, that kind of goes without saying. And then, when they get the traction, the price goes up, and it's harder to get in, and you're trying to compete to get in the deal, right? And so there's these things that you have to trade off. And so I think, when we're kind of unclear, we like the founders, but we're not big on. We're trying to figure out the space, where we'll really make calls rather than back checking the person. We try to generally trust them and other cues that we have. We'll do standard diligence on that type of stuff, like customer calls, calling, pilot customers for SaaS companies, all of that.
Susan's not paying attention, so we can sneak in one more question. Oh no, she's back.
Thank you, Shawn and Vijay, so much for your time. So, big round of applause.